What's going on, everybody? Good morning, and welcome back to Beat the Bell, presented by Kane Capital. It has been quite the wild week. When was the last time we saw this sort of selling? From my understanding, things have changed from the last time I got the opportunity to trade. So as you guys saw, I wasn't on the show on Wednesday, haven't done any trading this week. I come in, I checked the charts this morning, and we're back where we started in June almost. So what's going on here? All right, Money Mander, good morning.
Pretty crazy. We'll do our best to dive into why we think this is occurring. But yeah, wiped out pretty much all of the massive July rally we saw. So Bears definitely getting the best of the Bulls here.
All right. Diamond Trades, good morning.
Alejandro, what's going on? Welcome back. Excited to dive into it. Let's get after it.
All right. Economic calendar, Fed forecast.
Yeah, so we'll start with the economic calendar. So the economic calendar, there's nothing today. We don't have any high impact news, but we do have some interesting stuff tomorrow. So next week. So let's take a look at next week's economic calendar. So we've got the most important things on there are going to be durable goods on Thursday. And then we've got Jackson Hole as well on Friday. Ryan, do we have? There she goes. Durable goods on Thursday is going to be important, as well as you get flash PMI and new home sales as well on Wednesday. And then Friday is going to be UMIS consumer sentiment and Jackson Hole, the Jackson Hole Symposium, where the Federal Reserve President, Chairman Jerome Powell will go ahead and speak about any sort of developments in the economy. We talked about it last week, or on the last show. This event has sort of been a big market mover over the last several years, and so definitely something that the markets will pay attention to. Last year, it marked that August high that ultimately led us to new lows. It took 10 months to recover back to those levels. So Jackson Hole sure to invite some volatility. Let's go ahead and cover this week's trading. So the market has continued to show weakness this week, as it has for much of August, really extending that drawdown. I think, over the past week, it was sort of a bit slower grind, lower choppy price action. And really in the last couple of sessions, we've started to see that acceleration to the downside, really getting some volatility on the downside and starting to break through some key levels of support. This week, all three indices are hovering down more than 2% from last week's close. The pullback has brought the NASDAQ about 7.2% off this year, off its year-to-date highs, with the S&P and Dow 5% and 3.2% off their respective highs as well. The bond market has also been making noise this week. 10-year close yesterday at 4.307%, the highest level in 16 years, and the 30-year rose to 4.41%, a 12-year high. So higher yields aren't just hurting stocks in the sense that you're going to increase your borrowing costs for companies, and you're also going to have a less attractive risk-adjusted return, but also in the housing market with mortgage rates this week rising to 7.09%, the highest levels in 20 years. So the turbulence seems to be the name of the game for every market across the board really this week as we head to the end of August. The last thing I'll cover here before I pass it over to Sal is Walmart earnings. So Walmart reported earnings yesterday before the bell that topped Wall Street expectations. EPS came in at $1.47 versus $1.32 expected. Revenues came in at 152.3 billion versus 148.9 billion expected. Same-store sales rose by 7.4% in the quarter versus the 5.5% expected by Wall Street. CEO Doug McMillon said in the earnings release, we had a strong quarter. Comparable sales were strong globally with e-commerce up 26%. We leveraged expenses, expanding operating margin and grew profit ahead of sales. Shares of the company traded as high as up 3.3% in pre-market before getting caught in the broader market sell-off and closing the day down just over 2%, likely on the lower guidance for the current quarter, with the company saying it expects EPS of 167, somewhere between 167 and 168 versus 171 expectations. So this is another example of when we talked about this, I can't remember whether it was Monday or Wednesday, but this is another example of, good earnings not necessarily being rewarded. And I know that you had the guy down in the current quarter, but I mean, all in all, the earnings were pretty good for Walmart, especially like when you compare them to the other retailers that reported this week. You look at TJX, you look at Home Depot, you look at Target. Walmart stands out in both their performance in the last quarter in the sense that they outperformed. And then you also have the fact that their guidance for the rest of the year, they actually raised full year 2024 guidance for EPS. I think that this is likely due to the fact that, in these companies in particular, why Walmart, sort of outperformed, in that group of earnings from this week is really when you look at it, Walmart really deals in a lot more like essentials and consumer staples, whereas, the other three do a large chunk of their business in like discretionary sales, clothing, home improvement, et cetera, things like that. So I think really the takeaway from this is I think that analysts are going to be watching very closely how consumer demand for discretionary products in particular, sort of goes throughout the rest of this year. The consumer is obviously the largest part of the economy, and with people expecting an economic slowdown coming into 2024, it would really make itself evident right in that consumer discretionary. And like a little anecdote, I mean, we even talked about the Rolex price index, going back to a couple months ago, and that thing is I wish we had a chart of that. I'll try and find one so we can get it up here before the end of the show. But yeah, Mander, what do you got?
Walmart, I think, unfortunately falls into just market sentiment with this one. It's really what we've been seeing all of earnings season. I think if Walmart posted this exact report a month ago in the dead middle of July, the stock's up 3% going into the open. And so a lot of that definitely has to come into it. And that's really what we've seen with all the earnings moving forward. But the one thing to look at here, especially with yields elevated, everything is really based obviously off the federal funds rate, but then treasuries as well. And so when you see mortgage rates running and obviously credit card rates are going to be running as well, I think that's a big hit we're starting to see into forward guidance and into this consumer that has really been resilient to hold the economy to where it's been at. If credit card rates continue to increase and mortgage rates are into 30-year highs, everything that the consumer is then basing their leverage off of to consume and to put money into the economy, that's obviously going to hinder forward expectations for revenues. The one thing I wanted to touch on, though, I mean, we've had the craziest week for downside catalysts, and it feels like every time I'm coming on here, we got something out of China as the country seemingly just landslides in economic news. Now we have something new with Evergrande that we just spoke of. We had Country Garden, which was the second largest property holder in China, defaulting on their debt, whether this was Monday or Wednesday. Now the largest property owner in Evergrande filed for Chapter 15 bankruptcy yesterday, which gives them bankruptcy in the U.S. while they still look to sort out their international debt. And this kind of leaving a lot of analysts sitting here saying China could truly be approaching their own Lehman moment here in the coming months when you have the biggest property owners in the entire country defaulting on debt, filing for international bankruptcy. I mean, this is like really, really bad news coming out of China. I think that also has, on top of the yields, a massive sliding effect here into the action we're seeing in price action here in the States. Obviously, they're the second largest economy in the world. And so if China goes under and really starts to have this quote unquote credit event and real estate Lehman type moment here moving forward in the coming months, obviously that's going to have major hindrance on us in the States with all the exports and business we do. And then the one thing other I wanted to hit on with yield. So obviously yields have been ripping through the roof, but really the one thing we've been seeing, which is very different than the last time we've been seeing it. Last one, Ryan, if you could for me. The one thing we're seeing that's different here is we're seeing the massive squeeze on the longer end duration of the yield curve here with the 30-year and the 10-year that you then spoke of, which while obviously that's not going to help stocks, what that actually does is uninvert this yield curve inversion that we've been seeing. And so the 210 inversion, thanks to this recent squeeze we've been seeing in the 10-year and in the 30-year, which both just ran to decade highs and took out that October high we had last year, that's going to uninvert. And we now have the 210 inversion sitting at 65 basis points from its 108 basis point low. And so as we've spoken of before, historically, the bulk of equity selling comes as this curve uninverts, which is kind of at the point we're at right now as you start to go from those lows to then even into the full uninversion as that spread turns positive yet again. The only caveat we have here, though, is typically when you have this curve uninverting, it's because you see the short end duration fall through the roof. And so instead of having the 10-year rising and cutting this inversion, typically you'd have like the 2-year or the 1-year notes falling as you have massive QE and the Fed implements big rate cuts thanks to something systemic breaking and or recession falling into. This is way different here. When you have the 10-year and the 30-year rising with the shorter duration sitting still, it's really because the markets are pricing in soft landing or no landing, and more so what we have here in this chart, just a higher for longer narrative. And so going into next year, bond markets completely repriced the likelihood of the first rate cut being at March and moved it all the way back to May. And then going into the September meeting, you had the majority favorite probability of seeing 5 consecutive rate cuts from March into September. That now got taken down to just 11% likelihood of seeing us be at 400 to 425 basis points by that September meeting next year. So really all we're seeing is higher for longer being priced in. with those shorter durations kind of sitting still. And so I think that's a vast difference. If we start to see this uninversion happen, it's not the same as we've had before, what stems massive selling in equity. So obviously we're seeing pretty gross price action, but typically when you start to see this uninvert, it's because some black swan event happens. You have the quote unquote hard landing and something massive falls where the Fed has to switch to QE. This is kind of different where it's saying the Fed is just going to hold where they're at for longer than was being priced in. And I think that's probably the most likely outcome. I'm hearing the words no landing coming a lot. And I think that's actually probably a decent probability here, is that there's no soft recession. There's no hard recession. We kind of just hold steady here and see how long the consumer can remain resilient with unemployment still unfazed. And so if we have no more rate hikes, but we don't get a cut for longer, I think that kind of throws this whole picture of what you would historically see as like 30% down draws from this uninversion. I think that's probably much different. Going into monthly OPEX here, though, last thing before I give it back to you, all of this is obviously stemmed into massive put and hedging. So the put to call ratio right now just hit the highest level we've seen since March, going back to the banking crisis, as people hedge kind of the historic gains we saw for the first half of the year. And obviously when you have massive put exposure, dealers have to then get short to get net delta neutral. And so all of this has kind of led to what we have right now in the past 3 days. S&P closed red the past 3 sessions and is red again going into today. But with today being monthly OPEX, we have $2.2 trillion of notional exposure going into today, which is the vast majority sitting on the call side. As you can see, the put to call ratio up until recently going into the month was very, very call heavy. And so we could see a massive unwinding here. $2.2 trillion worth of notional exposure, mostly on the call side here. Most of them probably now expiring out of the money. So if we start to see a big unwinding and dealers can then get rid of these longs they've been holding with the outstanding calls, I'm kind of thinking we could actually see a pretty big slide here in monthly OPEX today. Now back to you.
You know, the only thing I think I wanted to, you made a bunch of great points, obviously. The only thing I wanted to hit on really was wouldn't that make it a soft landing to your no landing comment if you said like we're not going to have like a hard recession?
I don't even know what no landing is. I keep seeing it thrown around. Like either you land softly and you know everything.
Right, that's what I'm saying. It's like what are the
no landing sentiment here? Is
either we get a recession or we don't. Like I don't know.
The whole thing is like right now with elevated rates, the elevated rates are more so just back to where they've historically been normal. And so I think the no landing thesis is that we now just have a return to normal and hold here for a long time.
Got it. Yeah. Yeah, 100%. 100%. The last thing I'll say is that the China thing too, I think like it is important to look at the fact that, you know, the entire rate hike campaign in the United States, it feels like people have been looking at the United States and looking at the U.S. banking system and saying, okay, where's the cracks going to show up? And I think it is important to sort of look outside of the United States as, you know, rising tide lifts all ships in the sense that, you know, when the Fed raises their benchmark rate, everybody else sort of has to fall in line. So, yeah, it will be interesting to see how that sort of develops over there in China. That'll be it for us here at Fed Forecast. Pass it back to.
All right, boys. Thank you for that. Let's take a look at the S&P. So the last time we took a look at the system chart, we were kind of basing over that July 12th breakout area, if you guys recall. And this was this level here. Now, we finally lost that level. The beautiful thing here, and what I continue to mention, is that the environment had shifted to short the pops. Okay, so obviously we knew that because we were trading below the 50 SMA on both the charts, but more importantly, on the 1 hour chart. And so momentum, clear as day, in favor of the bears. So those who spent the majority of their time and effort attempting to find where this thing was going to bottom, obviously, were in a worse position. And there was a higher opportunity or higher chance of getting stuck in some of these trades. So while we got that incredible trend in July, after we got the buy signal and we rallied above the 50 SMA, now the tide has changed. And when the regime shifts, you don't want to get caught fighting the old war. So hopefully everybody was able to make some adjustments and use the system in their favor in order to spot some of this selling coming. Now, the same thing remains true as long as we're trading below the 50 SMA, that bears are in control. Once we get the break back over the 50 SMA, on both the charts, that's when the bulls have an opportunity to rally from a trend and momentum perspective, right, guys? So this is not talking support and resistance levels. This is simply talking some key moving averages on some higher time frame charts. You also, of course, need to be charting your key support and resistance levels. You want to see resistance levels clear for bulls to regain control. But so far, especially taking a look this morning at the S&P futures chart, we are breaking down below some key supports. So keeping an eye on that. That's going to do it for the system. I'm going to pass it over to Stock Snipa now for Bet the Bell.
Good morning, guys. We got some pretty interesting questions for you today on Bet the Bell. Looking forward to some of these, but I'm going to go ahead and start it off with our typical question. Green or red? Let's take a quick look at the standings and see how everybody's doing. We can see that Diamond has surpassed Alejandro now at a 65% win percentage, which is pretty crazy.
How do you show what's going on with your green screen here? What are these technical difficulties?
Yeah, it's pretty green.
That's like it's not a green screen. That's like a shit brown screen. Don't fix it now.
Dude,
all right. Keep it going.
Okay, man. So yeah, I'm reporting live from a hurricane. You're right. But we look at the standings there. We could see that Alejandro is in first place. Diamond is in first place behind Alejandro, 65% win percentage. But that goes ahead, and I'm going to transition into our first question of the day, green or red on the day. I'm going to start this one off with Money Mander.
I'm going to take the obvious bet here in red. Q's down about 1%, S&P down 0.5%. I think we probably stick red today.
Okay. Diamond, what you got, green or red today?
I'm going to take red. Not going to try and be a hero. OPEX day, anything can happen, but I mean, we're already down 1%. So take red.
Logical answer. Hondo, what you got?
I'm going to go red.
Yeah, I'm going to have to take red as well. I feel like it's a free win. That's
a green.
Oh, now you just jinxed it with the free win.
That's a green, ladies and gentlemen.
No. We'll see. But I'm going to go ahead and dive into the next question we got here. Is the top in on the year? Do you think that we have already seen the high of the year? And do you think it is going to be downhill from here till next December / January? What do you guys think? I'm going to start this one off with Diamond.
This is actually a really good question. I want to say no. I truly want to believe that I'm right about that too. But I mean, look, Matt came on Wednesday and even told us, right? The positional data that was extremely bullish throughout the rest of the year sort of shifted, and that really started with the credit downgrade by Fitch and Moody's. So I'm going to say no out of like a little bit of hopium. But I mean, look, it's a good question. I think that, you can't go wrong taking no. I think there are definitely some reasons for concern out there, at this point.
Okay, I like it. Mander, what you think? I already know what Mander's going to say.
I hope I'm wrong in saying this, and I hope Diamond's right, because the hopium in me wants to say we take out that high of year into the end of the year, but I think there is I'm leaning that I think the probability is we trade flat or slightly down for the rest of the year versus now having to have like a 10% move to the upside to take out that high. So unfortunately, I think we probably did set top for now.
Hondo, what you got? Top in for the year or no?
No, we're going to blast through those highs. We're going to rally hard as shit into the end of the year. This, to me, is a beautiful opportunity to trap some more shorts. You get a cute little 300, 400-point pullback after absolutely ripping everybody's face off for the past 8 or 9 months. And, the market just doesn't go straight up. But seasonally, this is making some sense. Hopefully next month, is a little flatter. Hopefully maybe we pick up a little bit to start the month. And then once that October's in the rear view, November, December, electric once again. And everybody is going to be saying, oh, my God, I remember when Tesla was at 213 in the pre-market and we didn't buy. Oh, my God.
I would say September, a historically bad month for stocks. So we'll start there. And then secondly, So think about it right now, right? The NASDAQ is 7% off the highs. Let's say that September does what September normally does and pulls back even further, right? So like looking at NASDAQ futures, we're at like 14.7. Let's say that we pull back to like, I don't know, 1,400, right? Which really is not that much further down than we are right now. That's another 5%. Let's say that September closes the month down 5%. So now we're down 13-ish, 13% off the highs. We would need a 15% rally into the end of the year. So October, November, December, a 15% Q4 rally to send Qs back to highs. I'm not saying that it is impossible at all. I'm just saying that seems like a lot, and that seems like an extremely volatile end to the year. So it seems like if we are going to go back and take highs, and Alejandro's right, then
We're gonna rally soon.
We're in for some real volatility into the end of the year. If that's what is going to happen, then I mean, geez, we're going to get a lot of volatility, and so I don't know.
I feel like
that's also, as a trader, I feel like I'd rather be in that camp too, because like the volatility would make it fun. You know what I mean?
As I mentioned, I haven't done any trading this week, so I feel like is it the Austin Powers movie where they froze the guy and then he wakes up like 100 years later? Like I got frozen, I woke up 300 points off the highs. So maybe I'm just like not understanding the full picture here because I haven't been there for every step of the way. But we'll see.
You haven't been in the trenches, brother. You haven't been in the trenches over the past.
I've been on the sidelines.
I got some PTSD from some of these sell-offs that we've had over the past 3 days, dude. They're just dumping it, man. It's crazy.
All right.
Yeah, so I'm going to go ahead and jump over towards the next question. Actually, first, I got to say, yeah, I think that historically September is a rough month for stocks. Therefore, I think that we will not see new highs this year. I don't even like looking at myself right now or my screen right now. Now, my next question is, with European bankruptcy reaching the highest level since 2015, Canada entering a housing crisis, and the Dutch recession, along with the Chinese problems that we're seeing, could we be on track for entering a global recession right now? I'm going to start this one off with Diamond.
I mean, who did the last downgrade? Moody's, Sal? Was Fitch the first one? And Moody's
was first, yeah.
Yeah, I mean, so according to Moody's, yeah, we're heading for a global recession in 2024. So, I mean, they know better than I do, I guess. What is that? Like, what is a global GDP dropping 2 quarters in a row? Like, I don't know where we are right now in terms of global GDP. But like even in terms of like earnings, like the S&P has been in an earnings recession, I think, going on 3 straight quarters now. So like it's not unfathomable that we could see this spread throughout the rest of the world. And that's one of the things too that, you know, when the entire like BRICS sort of alliance was coming out and people were freaking out about how the dollar is going to go to zero and the United States is done for. And it's like, dude, look around the world. Like, you think that other people are in a better spot than us? Like, a lot of these countries are not. So like, let's get that situated first. Like, you know what I mean? Like it's not a situation where like, you know, there are definitely some headwinds that the United States and the United States economy is facing, but like look globally and like, we're not alone in that. And so, yeah, I think it's totally possible. Totally possible.
Yeah, I agree. We're not even in the worst case scenario. There definitely are people doing worse than us, especially like Canada and a couple of those guys. But I'm going to go ahead and jump over towards Honda. What do you think? Is a global recession in store in the near future?
I don't know, brother. I'm phoning a friend. Money Mander.
I'm taking the same boat as Diamond. I think realistically, if you look around the globe right now, the reason we're not is because of the U.S. And so like he said, other countries are faring a lot worse than we are, like significantly worse. Obviously, we're the economic powerhouse of the world in terms of trade and exports and this, that, and the other. But I think global recession could induce before like a U.S. recession does, if that makes any sense. I think other countries are doing so poorly that if we stop being the apple of the market and throwing the globe on our back, and even if the U.S. economy goes flat, I mean, everyone else is already in some tailwind. So I think Wells Fargo, I mean, banks are forecasting it. Moody's, you know, the credit rating agencies, they got a lot smarter people than I crunching some crazy numbers. And if that's what they're going to say, I'm going to ride the coattails.
Yeah, I'm gonna have to agree. I think that a global recession is in the near future. Just like Diamond was emphasizing, though, some people have it worse than us, so might not be the worst thing ever for us.
I think what's more important would be the severity, and more so, especially with the way the globe is going. We're doing a ton of tech exports and semiconductors, and everything you've been seeing that's really led this rally off of lows is what our economy is strong in, and I think that's what's really the big driver in the globe right now. And so even if other countries that aren't producing semiconductors and aren't doing all the tech revenues that we are, if they start pulling down, I think we're poised in the best position to at least have a mild recession here in the States.
I like that. I'm going to go ahead and transition to our last and final question for Beat the Bell today, or Bet the Bell today. I'm sure many of you guys have seen the news or heard the news. Samuel Bankman-Fried has now been placed in custody. He is now inside of a Brooklyn jail, notorious for poor conditions. Do you guys think that this brings justice to those affected? I could say I personally was not involved with SBF or any of that entire crypto scheme, but I wonder, and I have to imagine that some people affected really like to see that. But I'm going to go ahead and start this one off with Money Mander. Does this bring justice towards the investors?
I mean, I don't think so. I think justice would be them all getting their money back. This one, I don't know, man. I kind of torn in this one because what he did was clearly different than someone who just had an accounting fraud with the IRS and they get sent to like 3 years of country club jail. Like, obviously, those people that just push the numbers on their own books should not be in with mass murderers and actual, like violent criminals. At the same time, I'm sure a lot of people who lost money with crypto.com or FTX, I mean, they're probably happy to see SBF go to like not a country club prison, but my only fear is for his safety. And I think, within the next couple of months, we could be getting a headline he no longer exists, which is kind of what I'm fearful of.
1,000%. I actually couldn't agree more. And like, I know that it sounds like pretty messed up, but like that's so true, where it's like we've seen these situations where people just sort of like escape due process. Famously Epstein when he was in a New York prison. So like, I think justice would be him going through due process and, having everything come out. And like by everything, we mean not just what he did, but like his co-conspirators. Like, you don't pull off schemes like this by yourself. Like, you need help. And I'm sure that he had that help. And I think that justice would be all of those people also being held accountable. Which I'm not even sure happens if he lives, right? Like we've seen it before where, the people behind the scenes that are responsible don't get held accountable. So I think that would be justice for anybody who's sort of lost money with the whole FTX situation. Would be everybody that was involved being, brought before a court, being held accountable and things like that. And hopefully that's something that we see this time around. I'm not super confident though.
Hondo, what do you think?
Well, that was a very intelligent answer by Noah. I think it's funny that he's in Brooklyn jail. Also, I mean, what is notorious for bad conditions? And is he in jail or they have him in prison right now?
Is he in Rikers or something?
It's in jail.
It's probably Rikers.
He's not getting out.
Is Rikers Brooklyn? Pretty sure it is.
I believe so. Don't quote me on that, but I'm pretty sure you're onto something there.
Well, it's in the water, so.
I agree with what Noah was saying, that and what Mander was saying, that real justice is, bringing everybody who was an accomplice, who, assisted him in committing these crimes to justice, and seeing this process out. And, hopefully nothing happens to the guy. You'd really hate to see that, but I don't know. It is what it is. But the other guys covered pretty much everything I wanted to say. So,
yeah, perfectly said. Diamond kind of hit the nail on the head this time with this answer. But that will wrap it up for Bet the Bell today. I'm passing it back to Hondo here.
All right, guys, that's gonna do it for Beat the bell this morning. Appreciate everybody who tuned in. Hopefully, you guys have had an awesome trading week. We'll be trading live all day in the King Capital Discord. You can go to king-capital.com to trade with us or scan the QR that's on the screen. Snipes is ridiculous green screen. It's just hilarious. All right. We will see you guys back here on Monday morning at 8:30 a.m. Eastern Time. Have a good one, everybody. Have a great weekend.